Welcome to Accountable, where your business is our business. Hosted by David R. Peters.
Hi, everyone. Welcome to Accountable, the podcast for CFOs by a CFO. Hey, my name's Dave. Thank you so much for joining us this week. We are trying something new here on Accountable, something that I'm excited about. We are going to offer audio CPE. So there's a couple of things that you got to do, but basically what I'm telling you is that you can listen to this podcast, take a short quiz, and then be able to qualify for one CPE credit. So that is what we are doing here on Accountable. Now, of course, you got a couple of things that you got to work through. First thing, and the most important thing, is that this is not NASBA approved CPE. This is not NASBA approved CPE. So I just want to make that clear for everyone out there. So there are lots of states out there that allow for CPE credit where you don't necessarily need NASBA approved CPE. My home state, the Commonwealth of Virginia, is one of those states. In Virginia, you don't necessarily need to take NASBA approved CPE. So what we are saying here is that if you are in a state that does not require NASBA CPE, then what you can do is you can take this podcast as an audio CPE option. So this is how it works. So you are going to listen to the podcast the same way that you would. And then what you're going to do is we are going to provide you a link in the show notes to this podcast. If you want to take this class for CPE, if you want to listen to this podcast for CPE, you click on the link in the show notes, and that is going to take you out to petersprofessionaleducation.com. When you are there, you're going to register for this podcast like you would a class on petersprofessionaleducation.com. You're going to pay a small fee and then be able to take the test. And then once you pass the exam, then we're going to issue you a CPE certificate. So that's how it works. Again, this is not NASBA approved CPE. This is a CPE that would apply to states that don't require NASBA approved CPE in order to get your certificates. And so that is the group that I'm talking to here. If you are in a state that does require NASBA CPE, then of course you can't take this podcast. So so that's the rub there. But anyway, but that is how we are going to do this. So this is something new that we're trying. I've heard from a lot of you that, especially if you travel a lot, that sometimes it's difficult to take CPE. I totally get it. I totally understand. Those of you that know me personally, you know that I travel a lot. And so this is something that we're trying to kind of help you out a little bit. You can listen to the podcast. You can download it before you get on your flight. Listen to it during your flight. Then, whenever you get to the hotel or something like that, you can log on to petersprofessionaleducation.com and you can get a CPE credit. So I'm hoping that this is helpful to all my friends out there who travel and who are kind of constantly on the go. This is something new that we're trying. Let us know if this works for you. I'd love to hear some feedback from you about what you think about this audio option for taking CPE. And so, let me know what you think. So let's move into today's topic because, this is something new that we're trying. But I think what is probably more exciting here is that we got a great topic here. The topic for today is we are going to be discussing Form 8300 reporting. And so Form 8300 reporting is something that I think a lot of practitioners, whenever I mention it to them, they say, oh, my gosh, Dave, what in the world is that? Form 8300 reporting is not new. However, the part that is new is that it's going to be required for brokers who deal with virtual currency, who deal with cryptocurrency, starting next year, starting in 2023. And so that is the reason why all of a sudden Form 8300 reporting is kind of top of mind, is because all of a sudden now we are dealing with a new requirement, and so a lot of accountants are starting to ask questions, because I think especially anything related to virtual currency, anything related to cryptocurrency, anything related to Bitcoin, it's kind of on the top of our brains right now. And so this is one of those things. This is going to be required starting in 2023. So after 2022, we will begin using this Form 8300 to report certain cryptocurrency transactions. So that's what's going on here. Let's back up a step, though, because I think we need to paint a little bit of context to the conversation today. So where this all started was with the Infrastructure Investment and Jobs Act. And so that was the infrastructure bill that was passed at the end of 2021. Now, if you have been paying attention in the news, we've been talking about sort of sweeping tax legislation for several months. I mean, really since, kind of the end of 2021, all the way up until now, we have continued to talk about sweeping tax legislation. And we really haven't seen it yet, but we are seeing some signs that we could see some things happening before the end of the year. We have what appears to be an agreement among Senate Democrats for some pretty sweeping tax changes. And so we'll keep an eye on those, but those still haven't been passed yet into law. So, we kept thinking that we were going to see this big sweeping tax legislation, and really a lot of us thought that it was going to happen at the beginning of the year. I know that I was on a couple of podcasts, a couple of radio shows. I did several presentations kind of in that November, December, January timeframe when a lot of practitioners, when they do their CPE, and I got a lot of questions around it. A lot of people said, hey, Dave, do you think that we're going to see the Build Back Better Act? Do you think that we're going to see that legislation being passed? And I said, yes. At the time, it certainly looked like we were going to see this big sweeping tax legislation happen. Really didn't happen, and then it kind of died for a little while. And now we're starting to see some signs that maybe we might get something even still before the end of the year. But, putting that aside for a minute, we did see a couple of tax changes, though, at the end of the year with this Infrastructure Investment and Jobs Act. So the Infrastructure Investment and Jobs Act was passed on November 5th, 2021. And for the most part, it was about where we were going to spend our money. It really wasn't a tax bill per se. It was really around spending on infrastructure and kind of where we were going to sort of place funds more than it really was about tax changes. However, that being said, there were two notable things that really came out of that legislation that I think if you're a tax practitioner, were pretty important. And so the first one was one that probably got the most attention. I don't even maybe think that there's a probably in there. I think it did get the most attention, and that was the peel back of the employee retention credit. And so the employee retention credit was supposed to be something that was going to extend through the entire year in 2021. So if you remember right after the American Rescue Plan Act was passed, we had a situation where it looked like the employee retention credit that you were going to be eligible for, the employee retention credit, businesses were going to be able to take advantage of that credit through the entirety of 2021. So all 4 quarters. And so that's what we thought was going to happen. Then the infrastructure bill came along and it actually peeled that credit back and made it so that businesses could only take advantage of that credit for the first 3 quarters in 2021. So just as a quick reminder, that credit was going to be 70% of the first $10,000 that was for $10,000 in wages per employee for each quarter in 2021. So in other words, one employee could generate what looked like $28,000 in credits as a part of that employee retention credit. However, the infrastructure bill took that credit and peeled it back and made it so that most businesses were only going to be eligible for that credit through the first 3 quarters of 2021. So it took what was a maximum $28,000 credit per employee and made it so that the maximum was now only $21,000. Still a good credit, but we could only take advantage of it for 3 quarters. So the infrastructure bill actually took that credit and peeled it back. Now, the exception to that was for recovery startup businesses. Recovery startup businesses were able to take advantage of that credit through all 4 quarters of 2021. However, if you were not a recovery startup business, then you couldn't take advantage of that credit in Q4 2021. You could only take advantage of it for the first 3 quarters. Okay, so that was kind of the first big piece of tax legislation that happened as a part of the infrastructure bill, is that we saw this peel back of the employee retention credit. Pretty big deal at the time. Now, the other part that I think kind of in some ways kind of became kind of secondary as a result of this. I mean, how many of us were dealing with the employee retention credit? How many of us even now are still dealing with the effects of trying to calculate the employee retention credit? You might be still amending, 941s and also probably amending, 1120s as well to deal with that employee retention credit. But the other part that was important is the Form 8300 reporting for cryptocurrency. And that is the part that I wanted to discuss here today. So the other part of the infrastructure bill is that we had this situation where now that cryptocurrency needs to be reported on Form 8300 if you are a broker in cryptocurrency starting in 2023. So not in effect right now, but starting in 2023, then we have this reporting requirement on Form 8300. And so this is something that I think that needs to get on the radar screen, because again, a lot of us are still kind of getting used to cryptocurrency and virtual currency and kind of all that stuff. And so this is certainly something that I think needs to be on our radar screen, especially if you have clients that are dealing and doing business in cryptocurrency. So that is who we're kind of targeting here. Now, let's take a step back here and talk a little bit about Form 8300, because we just said that, that now we have this reporting requirement. And so that's got to be your next question is you got to say to yourself, okay, well, great, Dave, but what exactly is a Form 8300? So what this is Form 8300 is a reporting form for reporting large cash transactions. So the rule is that you got to report transactions of cash received in the ordinary course of a trade or business that are $10,000 or more in a single transaction. Okay, so I said a mouthful there, so let's just make sure that we got it. This is for situations where if you are in a trade or business, okay, so you're acting as someone who is in a trade or business and you receive cash of $10,000 or more in a single transaction, then that is something that we need to report using Form 8300. That's the rule, okay? So got to be in a single transaction, $10,000 or more, and I need to be in a trade or business. Now, I think kind of the natural next question is that people ask, they say, okay, well, does this just apply to corporations? The answer to that question is no. It is a requirement that is on any person. That's the way that that it's described in the Internal Revenue Code. That's the way that it's described on the form as well. So in the form instructions, one of the things that is clear in there is that this applies to any tax person. Okay, and that's not meant to be confusing because really what it is it means that it applies to everybody. It's going to apply to individuals. It's going to apply to trusts and estates. business. It's going to apply to corporations. It's any taxpayer that is acting in the ordinary course of business. Now, that part's important here too. I've had a lot of people that have said to me, they've said, well, Dave, so I, have a cryptocurrency account, or maybe I have a client that, is trading in cryptocurrency. Does this apply to them? And the answer to that question is usually no, because most of the time, if you're just investing in cryptocurrency, that's not in the course of a trader business. That's not acting within the ordinary course of a trader business. That's somebody investing. That's different, okay? What we're talking about here is we're talking about situations where someone is acting in the ordinary course of a trader business. Those are the folks that we're talking to here. So if they're receiving large cash transactions, $10,000 or more in a single transaction, that needs to be reported on Form 8300. So that's the idea behind that. Again, it is going to be any person is going to have to do this. So if I'm, maybe an individual, I'm filing a Schedule C, that would apply to me. If it is a part of my Schedule C trader business, then it's going to be reported on Form 8300. Now, there are various rules that must be applied to determine if the transactions are related. Okay, now, why is that important? Well, the rules are, and probably a lot of the gray area when it comes to Form 8300 reporting is what exactly do we consider to be one transaction? And the way that it works is that there are several rules that are out there that basically describe situations where we assume that everything that is that happens is considered to be one transaction. So in other words, there's sort of like what I would refer to as kind of aggregation rules. So situations where we are going to take related transactions and we're going to put them together and we are going to test them together cumulatively against this $10,000 requirement. And so the difficulty that really happens with this form is a lot of times in the case of trying to figure out what is exactly is considered to be one transaction for this purpose. And so that's the part that we need to spend some time on. Now, in addition to kind of the rules that are laid out in the instructions on Form 8300, because that's really what we're talking about here today, is the instructions related to Form 8300. But in addition to that, you kind of have this catch-all provision in the instructions that basically says that taxpayers may also voluntarily report transactions that may not necessarily fit the specific requirements of the form. So, when would that happen for someone? When would that be a situation where that might occur? What would that look like? Well, what that would look like maybe a situation where, somebody is paying for something in cash and the taxpayer is like, you know what? This just doesn't seem right. This doesn't seem right. It's a large amount of cash. Yeah, it's not $10,000. Yeah, technically it doesn't really meet any of the aggregation rules or anything like that. So, technically speaking, do I have to report it? Well, maybe not, but this just feels off. It feels like maybe this person is maybe doing something that may not necessarily be something that we want to be a part of. Maybe it's something that we look at and we say, yeah, I don't know what this person is up to. I don't know that they're necessarily laundering money or doing something, illegal, but at the same time, it just feels off. It just feels off. And so therefore, we may voluntarily decide to file Form 8300. That is something that can be done, and something that is talked about in the instructions to this form is that that could be considered to be a Form 8300 reportable transaction as well. So we're going to talk about kind of the letter of the rule, kind of the bright line requirements of the form itself. However, don't forget that kind of you also have this sort of overriding rule that basically basically says that, even if you don't meet those requirements, that you can still report that on Form 8300. And, that might be something to talk to clients about too, especially if they have, cash-based businesses and everything. There is extra scrutiny on tax-based businesses. Certainly there is a lot of scrutiny around that because, think about the dangers of a cash-based business. I mean, you as a CPA, as a professional, one of the things that you're worried about with a cash-based business is you're worried about record keeping, and you're worried about, the potential for audit. You're also worried about the potential for, maybe the person is dealing with, customers and vendors and things like that, maybe in a way that is maybe not always on the up and up. Those are the things that you're worried about. And so this is one way to sort of put somebody on the IRS's radar screen if the cash-based business owner maybe feels like something is off. And so that's the important part that we want to stress here today. So moving into the actual aggregation rules, because I said that is where a lot of the complexity is for this, on this form. Certainly that is indeed the case. And so the first rule is that if you have any transactions that occur within a 24-hour period between a payer or his or her agent and the recipient, that is considered to be, by its very nature, to be one transaction, okay? So if I have multiple transactions with the same person in a 24-hour period, you're going to aggregate those transactions together for purposes of evaluating whether or not you have exceeded this $10,000 rule, okay? So let's say that I have somebody come into my place of business, and they are going to pay cash for their product or their service that they have gotten from me. And they're going to pay cash. And so the first transaction, they come in and they pay $6,000 in cash on Monday night. Okay, so it's Monday night, 7 o'clock, and they're my last transaction of the day. They pay $6,000 in cash, and I go through, I give them a receipt, and they're kind of on their way. And then let's say that they stop by the next morning at 8 a.m. and they pay for another product or service from me in the amount of $5,000, okay? Well, even though that is maybe two transactions, the way that the Form 8300 looks at it is that you're going to aggregate those transactions together. When we are talking about 24 hours, we truly mean a 24-hour period, okay? So in other words, anything that happens within a 24-hour period, you're going to aggregate those transactions together. Now, why would you have a rule like this? Well, what the IRS is concerned with is that if you just kind of put out there a $10,000 rule, that people, if they're maybe aware of this rule, that what they're probably going to do is they're probably going to do things to make sure that they're under that $10,000, right? Because, that would make it so that the shopkeeper, the owner of the business, doesn't necessarily have to report this amount on Form 8300. So, so they would kind of purposely maybe try to go right up to the line with cash transactions, but don't go over it, right? So pay in $9,999, but don't go over that $10,000. Well, these aggregation rules make it harder for somebody to do that. And so anything within a 24-hour period, that is going to be considered to be one transaction. Now, the part that I want you to pay some attention to is that includes people's agents, okay? So if I am dealing with a person and then the next day maybe their assistant comes in or something like that, that is still considered to be one transaction if it happens within a 24-hour period. So that's the idea. So again, don't sort of gloss over that agent piece as well. Now, The next rule is one where kind of puts the emphasis on what the business owner knows or should have known. Okay, and we've seen this before. I mean, basically, this is the idea that we can't have our client kind of bury his or her head in the sand. If they're a small business owner, they can't kind of bury their head in the sand and just say, well, I didn't actually know what was going on, and kind of make excuses when they really should know what's going on. That's really the idea behind it. So any transactions, if the recipient knows or has reason to know that each transaction is one or of a series of connected transactions, even if they stretch beyond a 24-hour period, okay? So let's say that we have a situation where we have a shopkeeper and they have a client that comes in. They pay $6,000 in cash at 7 p.m. on Monday night. They then wait until 7:01 the next day, okay, so 7:01 p.m. the next day, and they pay the remaining balance on their transaction again in cash, and let's say that remaining balance is $5,000, okay? Well, then we're at $11,000. Are we outside of the 24-hour period? Yeah, we are. We are outside of the 24-hour period. Are those related transactions? Well, in my example, certainly they are, because you're paying off on one invoice. So yeah, of course those would be one transaction. But even if they're not, if they are related transactions, so maybe you're paying off for maybe the main service kind of in the first payment, and then maybe you're paying off maybe an associated service in the second payment. Those could be related transactions. And so what we're saying here is that even if something is technically outside of that 24-hour window, that in itself can create a situation where, that's going to be a reportable transaction because the owner of the business knew or should have known that those are related transactions, and that those related transactions should be aggregated together for purposes of that $10,000 requirement. Last one here, last major one, I should say. If a taxpayer receives more than one cash payment for a single transaction or for related transactions, he or she must report the multiple payments anytime you receive a total amount that exceeds $10,000 within any 12-month period. Okay, so let's think about that here for a minute. So let's say that we have a situation where maybe it is beyond a 24-hour window, but we again have a series of related transactions, or one transaction where the person pays us in cash and then pays us again maybe 6 months later. That would also be a reportable transaction. Now, the part that I think a lot of people have some issue with is that they say, they look at the 12-month rule and they say, okay, that seems like it sort of contradicts the 24-hour rule, because we just got done saying that any transactions between the same payer and the same recipient, okay, or the payer's agent, that if they happen within a 24-hour period, they are assumed to be related. That's the part that actually separates these two things, okay? So if they are within a 24-hour period, or if you have a situation where the business owner knew or should have known that they were a part of one transaction, then that is considered to be a reportable transaction if it's up over $10,000. So if it's within a 24-hour period, it's assumed that that is a related transaction. Okay, so it's assumed if you get two payments within a 24-hour period, okay, then that is considered to be a related transaction. Just off the cuff, it's going to be related if you receive those payments. Any payments that you receive within a 24-hour period are aggregated together. Now, the 12-month rule is a little bit different, because what it's saying is that if it is part of one transaction or a series of related transactions, which we're essentially saying is one transaction for our purpose, that is going to be all aggregated together as well if they happen within a 12-month period, okay? So if you're within 24 hours, then all of those transactions within a 24-hour period are assumed to be related. If, however, they happen within a 12-month period and they are a single transaction or they are part of a series of related transactions, then you aggregate those together. So notice the difference. With the 24-hour rule, there's an assumption being made. The assumption is that all the transactions that happen within a 24-hour period are, by their very nature, related. The 12-month rule says, okay, if they are within 12 months of each other and they are related or they are part of a single transaction, then they're going to be reportable if they're up over $10,000. So the 24-hour rule makes an assumption. However, the 12-month rule makes less of an assumption, okay? So it's an assumption that is being made that if you're receiving payments from the same payer within a 24-hour period, those have got to be related. The second one doesn't say that. What they say is they say, all right, if you're receiving, if you're receiving payment on the same transaction or a series of related transactions within a 12-month period, that is also going to be reportable. Okay, so let's do an example here. We've been talking through a few things. Let's try to put some examples to it. I've been trying to put some examples here already, but let's do another one here. So let's say that my friend Melissa, that she invoices me for the sale of a retail product for $10,508. So she is going to invoice me for this product. I pay Melissa. I pay her $4,508 on Monday, $2,000 on Tuesday, and $4,000 on Friday. Okay, so I'm paying off my debt, but I'm doing it a little bit at a time. All of those transactions are in cash. Even though the payments are made over more than a 24-hour period, Melissa should know that the payments are connected since they are all related to the same transaction. So I keep making examples where there's two payments. What if there's a series of payments? If they are all related to the same transaction or a series of related transactions, then that is going to be reportable. So in that situation, Melissa would need to file a Form 8300. She is acting in the ordinary course of business, and therefore she is going to have a series of transactions that she either knew or should have known that they are part of a series of related transactions. And if it's all part of the same invoice, of course you know that it is a part of the same transaction. So therefore, that's going to be reportable by her on Form 8300. So it's the recipient that is going to report this on Form 8300. Now, what if we were to change that up a little bit? And then let's say that, instead I pay Melissa $4,508 in cash on March 15th. 6 months later, on September the 15th, I pay Melissa the remaining balance due of $6,000, again, all in cash. So what would happen then? Well, in that instance, even though we're beyond the 24-hour period, we are now receiving two payments on the same invoice, both in cash, within a 12-month period. And so that would also require Form 8300 reporting. When would the Form 8300 reporting requirements, when would that have to be met? Well, it would have to be met after the second payment is received, because at that point we have exceeded $10,000, okay? So on the second one, Melissa's got to know that that is part of the same transaction. Right? I mean, I'm paying off on the same invoice. If it's part of the same invoice, then of course it's a part of the same transaction. And if it's part of the same transaction, then you have to aggregate those payments together. Okay. Now, I think that the part that, I think a lot of practitioners would probably be interested in is just how exactly do you prepare clients for this? Because we're talking about concepts here for the most part. And I'm going to be talking here in just a minute here about, when do you file the form and all that stuff. But, I think a lot of practitioners would probably say to themselves, they say, well, what exactly what exactly do I tell my clients about this? Well, Again, I think that, you would really try to get them to keep good records. I mean, I think that is really what you got to do, because they need to not only pay attention to the fact that somebody paid them, but also how did they pay them? Did they pay them, through checks? Did they pay them through credit cards? Or did they pay them in cash? Okay, because if they don't have kind of the method of payment written down somewhere, well, then they're going to have trouble complying with this requirement. So a lot of cash-based businesses, that is, I think, where the difficulty is going to lie, is this idea that, they're going to have to not only keep track of the fact that somebody paid them, but also how they paid them, that is also important as well. Okay, so again, this is something that I think that we need to lead the way on as practitioners. We need to make sure that we are the ones that are telling our clients kind of how to do this and how to set up for being able to comply with this requirement. Now, when exactly is the Form 8300? When is it due? So generally, it's going to be due 15 days after the cash payment is received, or if it's a series of payments, it is going to be 15 days after the one that is received that put us over the $10,000 mark. Okay, so if I'm receiving a series of transactions, we're going to wait until we receive the one that puts us up over 10,000. At that point, then we have the reporting requirement. And in general, that reporting requirement is going to be due 15 days after the cash payment is received, that puts us up over that $10,000 mark. Now, if 15 days, if that lands on a holiday or a weekend, well, then when is the form due? It's going to be due the next business day. So that's when the form's due. It's going to be due the next business day if 15 days lands us on a weekend or a holiday. So, just like we would typically see with a tax return or something like that, that's typically the way, right? I mean, if a tax return due date ends up being on a holiday or something like that, then we typically make it so that the deadline is going to be the next business day. We've seen this a few times with the April 15th deadline and for several others as well. So same deal here. If more than one report is due for a 15-day period, then the taxpayer can file a combined report. So if there is multiple reports that need to be filed by the taxpayer, because maybe they've had multiple situations where they've gone over $10,000 in cash being received, then what they can do is they can aggregate those reporting requirements. But what they're going to do is it's got to be situations where you have more than one report due within a 15-day period in order to sort of combine those filings. So if you have a situation where more than one report is due in a 15-day period, then the taxpayer can file a combined report. Now, the other piece that I think is important here is that there is a retention requirement that is imposed on your client. It's a retention requirement that is on the business owner, and the business owner is supposed to retain any Form 8300s for 5 years. Okay, so they got to keep those reports that they file for at least 5 years if they end up filing a Form 8300. So that part's important as well. I think again, when you're talking to clients, that's the part that we gotta make sure that they know about too. It's not just enough to just kind of file the form. They also got to make sure that they're going to hold on to those forms for at least 5 years. Something that I think is probably obvious to a lot of us practitioners, but may not be sort of less obvious to your clients. I actually get this question maybe more than I think maybe some people might think. Is a lot of clients, they say, well, does it matter if I keep things in electronic form, or if I keep things in paper form? And the answer to that question is no. I mean, if you keep, paper records or electronic records, both of those things are fine. I mean, you can definitely do that. So just as a general rule, paper forms versus electronic records, both of those are fine. Especially this day and age. I mean, I think more people, keep electronic records, but, and the advantage too is electronic records, less of a chance that, something gets damaged. I've had a few clients that have told me about tax records that have gotten damaged due to flooding and stuff like that. And so, probably better to keep electronic records, but in general, for this one, the requirement is to retain a copy of the Form 8300 for at least 5 years. That part's important. All right. So at this point, we have covered a fair amount about the Form 8300. We've talked about kind of what the form is, what it's designed to do, and what exactly you need to do in order to file the form. And we've talked specifically about the aggregation rules. Again, I think that is where a lot of the complexity lies. So let's bring it back, though, to the infrastructure bill, because that is the part that I think is probably has made it so that this Form 8300 reporting is kind of back and kind of top of mind for a lot of practitioners. And so now, starting in 2023, there is going to be Form 8300 reporting for situations where you have a broker that is dealing in cryptocurrency transactions. So who exactly is a broker for this purpose? And so the way that the definition reads is it's going to include anyone who, for consideration, effectuates the transfers of digital assets on behalf of another person. So anyone who, for consideration, effectuates the transfers of digital assets on behalf of another person. So it's not just cryptocurrency. It's we take that definition out a little bit wider. We make it so that it's not just cryptocurrency per se, it's digital assets. Now, you may be saying to yourself, well, Dave, that's kind of splitting hairs a little bit. I mean, isn't any digital asset, cryptocurrency? It is. But I guess the part that I would just sort of make people aware of is that the way that this definition is worded is that digital assets has a little bit of a wider definition, because I think that, really what the IRS is trying to get at with this is that we don't want to be necessarily, kind of trying to figure out whether or not, some new digital asset that comes out, whether or not it falls under this requirement. Okay. In other words, we try to put together sort of a blanket definition that basically covers us kind of no matter what comes out, out there in the world. And so, certainly cryptocurrency, digital assets are one of those things that's an evolving area. I mean, isn't it? I mean, when we're talking about the things that are out there right now, it's an evolving area, and certainly it is possible that we could see a new digital asset that comes out, and automatically it would probably fall under this definition. Just to make it so that we're kind of being complete here, the way that we talk about digital assets is that a digital asset is any digital representation of value recorded on a cryptographically secured distributed ledger or any similar technology. That is the way that we describe it. So it's a little bit wider than just kind of a cryptocurrency per se. It is meant to be a little bit of a wider, more general definition that is going to be caught here. So a couple of things here to just remember that Form 8300 reporting is just for folks that are effectuating the transfers of digital assets on behalf of another person. That is the people that are going to get caught within this Form 8300 reporting. So, but Form 8300 is for any tax person. So it could be any person that is caught up in this, but they need to be acting within the ordinary course of a trade or business, and they need to be effectuating transfers of digital assets on behalf of another person. In other words, they need to be a broker. So they need to be a broker in order to kind of fit into this definition and amongst the people that need to report on Form 8300. So again, could be any person. So don't worry about business form. I guess that's maybe the major point that we're trying to get across here. Don't worry about business form here, because business form doesn't matter. It doesn't matter if we're an S corporation. Doesn't matter if we are a Schedule C. Doesn't matter if we are a trust or an estate. Okay, none of those things matter. The part that is important is that we are effectuating the transfers of digital assets on behalf of another person. We're acting as a broker in digital assets, and we are acting within the ordinary course of a trade or business. If you are just investing, that is different. So if my client's just investing in cryptocurrency, that's not going to be caught up in Form 8300 reporting. What is going to get caught up is if they are acting within the ordinary course of a trade or business. And again, I'll read that definition one more time as it pertains to digital assets. It's any digital representation of value recorded on cryptographically secured distributed ledger or any similar technology. So that is kind of where we draw the line there on this Form 8300 reporting. Let's talk a little bit further here because I think that there is one other piece that I also want to make clear, because we've had some changes here more recently in our markets, and I just want to kind of touch base on a couple of those things because there's been a lot of stuff in the news about digital assets and kind of cryptocurrency and Bitcoin and all of these other things. And so one of the things that I think is important to remember is that what exactly some of these newer investment things that are out there, these newer investment vehicles, what exactly those are, and more importantly, what exactly they're not. And so one of the things that has come out more recently is we've had a couple of situations where we now have Bitcoin exchange traded funds, so Bitcoin ETFs. And the thing that I would say on that, and I was those of you that have followed me on various social media channels, you may have heard me discuss this. But one of the things that I had the pleasure of talking to some folks on Bloomberg about is what exactly the ETF is. Okay, an exchange traded fund in Bitcoin is not a direct investment in Bitcoin. Okay, so there are other types of exchanges that are out there that deal with Bitcoin. Okay, so that is something out there that exists. However, an ETF is basically a group of investments that's kind of put together that basically act as if it was a direct investment in Bitcoin. Okay, so it is not a direct investment in Bitcoin. However, it is an investment in something that is made to move as if it is a direct investment in Bitcoin. So an exchange traded fund is allowed to be on a regulated exchange. That's kind of the bigger message here is that with a Bitcoin ETF, Bitcoin ETFs are allowed to be traded on a regulated exchange. Direct investments in Bitcoin are not. Okay, so right now, as we're speaking, a direct investment in Bitcoin on a regulated exchange is not allowed. Okay, that's not something that has been something that's out there yet. So you can buy, however, a Bitcoin ETF on a regulated exchange, but you can't buy direct investments in Bitcoin on a regulated exchange. Hope that makes sense. So the part that I think is important here is that a lot of the things that I think a lot of practitioners are asking right now, and a lot of clients too, is they're saying, well, why is the IRS so concerned about digital assets? Why are they? Why do we see see cryptocurrency being reported on Form 8300? Why do we see this whole big concern around digital assets? Why is this such an issue right now? And the issue is that for cryptocurrency exchanges and for places where we can buy and sell Bitcoin, that they're not regulated. That's the part that we are concerned about. That's the part that the IRS is concerned about. As an investment advisor, that's also the part that I'm concerned about too. When I'm dealing with, when I'm talking to my own clients about that, is this idea that that it is an investment that is out there, but the regulation and the transparency that comes along with regulation, that's the part that's really at issue. So the part that's really at issue here is the transparency around it. One of the things that a lot of us practitioners experienced during the last busy season is we probably had some clients. I know I had a few that came in, and what they said was they said, I never got a 1099 for the trades that I made in Bitcoin or cryptocurrency and digital assets. And so that is the part that I think is maybe a little bit of a concern for us practitioners is we look at that and we say, okay. So, because if it's not a regulated exchange, sometimes the client sort of ended up in a situation where they didn't get a tax form. Even if they don't get a tax form, the client, him or herself, is still responsible for keeping track of those records. And so that is the part that for some of my clients, that was an issue, making sure that they had the records that they needed to have in order to comply with IRS requirements. I think that's something that we need to get across. And also, too, that should give us some ideas about, kind of why this is such a concern for the IRS and for kind of regulators in general is that just the transparency aspect of these all other methods of obtaining things of value, all of these digital assets that are out there now. And, we're starting to see a trend. I mean, probably since we have some cryptocurrency that is out there and seems to be working towards mainstream acceptance, chances are good that we're probably going to see more. I think that the biggest thing with the Bitcoin ETF is that that sort of maybe signals a more sort of mainstream acceptance around Bitcoin. And so I think that is something that I think is interesting. And we'll see how all of that turns out. So exchange traded funds, again, are not the same thing as a direct investment in something. Exchange traded funds, for the most part, trade like stocks, and they are available on regulated exchanges. However, as of right now, a direct investment in Bitcoin is not something that is available on a regulated exchange. So just something to just make sure that we're clear on. I've gotten a lot of questions about that, so just wanted to throw that out there as well. So, again, lots of good stuff here. Hopefully this was helpful in terms of kind of bringing home some of these ideas. If you've been hearing about Form 8300 and you're like, hey, I don't know what this is, then I would say that you're maybe not alone in that. There's a lot of practitioners that have been asking me about that. Again, the big rule here is that you're reporting things that are up over $10,000, payments that have historically been made in cash. And what we're saying here is that if you're a broker in digital assets starting in 2023, that you're also subject to Form 8300 reporting. And so it used to be kind of something that was just kind of for cash-based businesses. Now we are expanding that out, and it is going to be for brokers in digital assets are going to be having to comply with Form 8300 reporting as well. So that's starting in 2023. Again, it's a $10,000 threshold. Pay attention to those aggregation rules. Also pay attention to the idea that I laid out at the very beginning, that if you want to get CPE credit for this podcast and you are in a non-NASBA state, you can do that. The way that you do that is that you're going to click in the link in the show notes here, and that's going to take you out to petersprofessionaleducation.com. And once you're there, Then you're going to register for this course, take a short quiz, and then you're going to be able to get your CPE certificate for this course. Again, though, not to kind of belabor the point here, but I definitely want to make sure that we're clear here. This is not available for NASBA CPE, so just to be clear on that. Okay, thank you so much for joining us. I hope that this was helpful to you. Whether or not you're taking this class for CPE or not, hopefully this maybe clears up at least a couple of questions for you in regards to Form 8300. All right, with that, folks, I look forward to seeing you on another episode of Accountable very, very soon. Thanks so much.